Stick with me for the next few minutes, because what's happening in Japan's bond market could be the first tremor of a much bigger financial quake. And by the end of this video, you'll understand exactly why some are saying a full-blown banking crisis might already be underway. Japan just held a 20-year bond auction, and demand came in at its weakest since 2012. That's not a warning sign. It's a red siren. As the world's second-largest bond market starts to crack, the Bank of Japan is still playing it cool, like the house isn't already on fire. As of December 2024, Japanese banks held about 14.5% of all Japanese government bonds, worth approximately 176.4 trillion yen. When bond prices fall sharply, the value of these holdings declines, which means the bank's assets shrink. If this drop is significant, it raises serious concerns about their solvency, because they may no longer have enough valuable assets to meet their obligations. In fact, given the scale of the losses and exposure, some analysts argue there's simply no way the banking sector in Japan is truly solvent under current market conditions. Japanese investors may be turning their backs on U.S. Treasuries, but that doesn't mean they're all in on their own market either. Despite rising domestic yields, demand for Japan's long-term bonds remains surprisingly soft. Dig deeper, and it reveals a more cautious, uncertain recalibration underway among investors navigating volatility, duration risk, and shifting fiscal dynamics. Japan's ultra-low interest rate policy, anchored by decades of near-zero or even negative rates, significantly reduced domestic returns for Japanese investors. As a result, capital sought higher yields abroad. The United States, offering comparatively higher interest rates and deep liquid financial markets, became a prime destination. This yield differential incentivized Japanese institutions and investors to reallocate capital into U.S. Treasuries, corporate bonds, and equities, effectively driving large-scale capital flows from Japan to the U.S. financial system. Japanese pension funds, life insurers, and asset managers began allocating more capital to U.S. tech ETFs and direct equity positions. Additionally, global fund managers operating out of Tokyo increased their exposure to NASDAQ-listed names through U.S.-denominated instruments, further accelerating the flow. As a result, Japan became a significant indirect contributor to the capital fueling the NASDAQ rally during the ultra-accommodative monetary era. It's true that Japanese investors are beginning to favor domestic bonds over U.S. Treasuries as Japanese yields rise. But at the same time, demand for newly issued Japanese bonds, especially long-duration ones like the 20, 30, and 40-year maturities, has been weak in recent auctions. That might seem contradictory at first, but here's how both can be true. Japanese investors may prefer Japanese bonds over U.S. Treasuries at the margin, especially as yields rise and currency risks are avoided. Currency risk is avoided when Japanese investors buy Japanese bonds instead of U.S. Treasuries because both the investment and the returns are in their own currency, yen. If they buy U.S. Treasuries, they're investing in dollars. That means even if the bond pays interest, they could lose money if the dollar weakens against the yen by the time they convert it back. So by staying in yen, they don't have to worry about exchange rates moving against them. That's how they avoid currency risk. But that doesn't mean they're rushing in with full conviction. The domestic demand is still relatively cautious and not strong enough to absorb the large supply the government needs to issue, especially for super long maturities. The recent move in Japanese yields has been fast and aggressive. When yields rise too quickly, it creates uncertainty. Investors may hesitate to lock in their money now, fearing that yields could rise even more and bond prices could fall further. So they wait. That hesitation shows up in the auctions as weak demand. Adding fuel to the move is the Bank of Japan's recent policy shift. In January 2025, the BOJ raised interest rates to 0.5%, and began scaling back its long-standing bond buying program. With less central bank support, long-term bonds are left to stand on their own in the open market, and investors are demanding more yield to take on that risk. On top of that, inflation is running hot. As of March 2025, Japan's inflation rate stood at 3.6% year over year, well above the BOJ's 2% target. And with elections approaching, there's growing speculation of more fiscal stimulus, which only adds to the pressure on bond markets. Together, these dynamics have pushed yields on 30-year and 40-year Japanese government bonds to record highs, sending a clear signal that investors are growing uneasy about the country's long-term fiscal trajectory and debt sustainability. So, while rising Japanese yields are starting to make domestic bonds more appealing than foreign ones, it doesn't automatically translate to strong buying in every part of the market. Instead, investors are cautiously rebalancing, avoiding long-duration exposure for now, and watching for signs of stability before committing more capital. If this gave you a clearer view of what's really driving the markets, make sure to like, subscribe, and tap the bell, because the next big shift won't wait. And neither should you.